House and Senate leadership are out in full support of the bipartisan debt agreement reached between President Biden and Speaker McCarthy. But in an op-ed for Project Syndicate, Harvard professor Ken Rogoff says that the last-minute deal does not solve the underlying political problem and that a truce is probably short-lived. Joining us right now is Ken Rogoff. He also served as chief economist at the IMF. And Ken, let's talk this through. I think you thought that if there was not a deal, that would be a very bad thing. You feel confident that this deal will get passed?
I don't feel confident about anything. I'm reasonably optimistic that it will get passed, but no, I don't know what will happen at the last minute here.
In terms of your concern, even if this does get passed, do you think a truce is going to be temporary? Why is that?
Well, I mean, the country's so divided, Congress is so divided. In normal times, having the possibility of the U.S. not paying its bills, I think technically we won't default on our debt, at least unless many months pass. But the idea that we would be doing that randomly for a long time is pretty unsettling, shows our institutions are pretty vulnerable. But, we have a likely presidential candidate on the Republican side, or quite possible, that denies having lost the 2020 election. Will probably point to a vice presidential candidate who agrees with that and talk about undermining institutions. And, the divisions are just huge. And I think you've talked about them, Becky and Joe, that the nature of the primaries pushes extremists in both parties. And the center is hollowed out, and it's very hard to strike a deal. Like, why is it so hard to pass the budget? Why don't some Democrats in the House vote with the Republicans and push it through? Why don't some Republicans in the Senate vote and push along a compromise and push it through? They don't even seem to be able to even think about that.
Just the idea of compromise being a dirty word at this point?
Yeah, absolutely, yeah.
All right, Ken, let's talk about what you see happening with the economy. We'll go with your optimism and assume that this gets passed, that the debt ceiling is kind of off the table as an issue, default is off the table as an issue. Let's talk about where we are with the economy, what you think the Fed is going to do next. The latest rounds of commentary that we've heard from Fed presidents all kind of point to them continuing to raise rates at this meeting in the next couple of weeks, early next month. What should we think about that? What do you think about that?
Well, historically, the regional Fed presidents have taken stronger positions, usually more hawkish than the board who sit in Washington do. So that's not unusual. I guess they're going to pause because they can raise rates later. I personally think real interest rates are going to stay high. I don't think interest rates are going to come down as fast as the market thinks. But I don't think there's a rush to get there at this point. They've raised interest rates quite a bit. I think they're more likely to go up, the Fed funds rate, over the year than to come down next. But I think right now, pause makes sense because it's who knows what's going on. It's been very hard to read the economy the last year.
What signs do you look to when trying to figure out what's happening in the economy?
Well, I mean, particularly the unemployment and looking at the employment figures, I think, is really the most important thing, because figuring out what output is really asks us to how do we recalibrate what happened after the COVID. I mean, there's quite a distinct possibility that we had a one-time downshift in our potential and might be growing back from that. It's really hard to say. But the employment, figures, and they have been getting weaker. I think we see. I'm looking at sort of more, microeconomic evidence that jobs openings relative to people looking for jobs has been declining. It's very weak in some sectors, like the tech sector. So we see some signs of weakening, but goodness, the underlying CPI, the underlying core inflation is still pretty strong and around the world. And it doesn't feel like we're anywhere near this. And I must say, I think the Fed's going to be facing harder challenges the next decade, not just now, because we're in an era where there's so many pressures pushing up prices, China slowing down for one of them. And a lot of pressures to raise spending. So I think the next decade, we may see the Fed lean towards allowing inflation more than it has the preceding decade.
I mean, that's certainly the argument for why some people think they're going to stop and eventually cut rates later this year, that they will abandon the idea of trying to get back to 2% inflation. You don't think that's the case, though, immediately?
Oh, they're not going to say that they're abandoning getting back to 2% inflation. I think what they're going to do over time is say, yes, that's our long-term goal, but we're going to take it down. I don't think they're going to abandon it. But I think what those people might be missing is that there are a lot of pressures upward on real interest rates that have happened since COVID. Start with debt is much higher. Even whatever this deal, the defense pressure for defense spending being higher around the world, everywhere is higher. Whatever happens with the green transition, that's going to cost money. Populism, if the Republicans in power, they're going to cut taxes. If the Democrats are in power, they're going to raise spending. There are a lot of pressures upward on real interest rates. I don't think they're going to go away anytime soon. I think we saw extraordinarily low real interest rates from 2012 to 2021. And I think the next decade, they're going to be maybe 1.5%, 1.25% higher.